talking to our very own Mike McKee and Vince Signorella about the state of confusion. It kind of seems like these markets are in some pretty wide ranges when it comes to inflation calls, recession calls. To you, which asset class is pricing all of this correctly?
Yeah, thank you. I think at Bulltick, the important thing that we've been looking at is what has taken us to this dislocations in the market where we have to ask this question. And the answer to that is the Federal Reserve stimulus and the federal government stimulus. So until that goes away or seems like it's no longer going to be a player, the most major player in the markets, then I think it's going to be a difficult question to answer. I refer, of course, to quantitative tightening, which the risk then is once we move into recession, that goes back to easing, manipulating further the fixed income markets and bringing on that risk appetite into the equity market. So I think that's what a lot of people are talking about or thinking about right now. Quantitative tightening, how long will that last? Will the Fed be able to both hike rates and roll off its balance sheet to the tune of almost $1 trillion? And as at the same time avoid recession. So I think that I think it's going to be very hard to really answer that question at this time period.
Kathryn, you bring up the issue of recession. Where do you think we are in the economic cycle right now? I look at the ISM data yesterday from services, mid-50s. That doesn't even feel like late cycle. That feels like mid-cycle in terms of the kind of numbers we're seeing there. Suddenly doesn't feel recessionary. Yet if I look at what has been happening in the bond market over the last couple of days, the pricing of recession has increased significantly. How do we get a handle on where we are in the cycle right now? The Fed certainly is signaling that at the moment it feels like it's got a long way to go in terms of its tightening.
Well, the economic cycle has peaks and troughs, and I think unequivocally, Guy, we have already seen the peak. So we are in deceleration. I think we're de facto in stagflation, something that with the Fed's recent adjustment of its economic forecast has acknowledged, because we have growth below potential. They're expecting 1.7 versus potential of 2.4, 2.5. With inflation, they even expect above 5% for this year. So that's stagflation. The next point in the economic cycle is recession. Pointing to the trough of the next economic contraction is impossible to say with precision. But what I can say is that, and I think we've been talking about this a lot on Bloomberg, is that the labor market, it's really hard to have a recession or say we're in recession when we have 3.6% unemployment rate, and you still have a consumer that's still spending on recreation and travel and hotels. And that's de facto what we're seeing. So my laser focus is on non-farm payrolls tomorrow, unemployment rate, labor participation rate. When we see a rollover in the labor market, and my estimation is that magic kind of number is 4.2%. So I think once we get to that 4.2% or even higher in terms of unemployment, we're going to be in recession. And that's what I'm looking at in terms of what could be the nail in the coffin for the consumer. I'll add one more thing. Inflation is not going anywhere. And I think the Fed knows that demand destruction is the only thing that will really bring inflation back to the 2% target. Gas prices can come lower, which they're unlikely to do so. We could have improvements in the supply chain. That'll help inflation. So will base effects, because inflation was really high last year. So by the end of this year, we do expect inflation to come down. But to get to the 2% target, my suspicion is that we need to have economic contraction. I think we are moving towards that as the next point in the economic cycle. And I'll go back to the other question that was asked. What asset classes got it right? How does the Fed respond to that? They can't take rates up too high and then bring them back down. My suspicion is that we go back to the old playbook or the new playbook, which is quantitative tightening, moving back into easing.
Well, speaking of that quantitative tightening, Chairman Powell has been very vocal about having the market perhaps do some of its work for it. If you look at financial conditions, for example, they've been in restrictive territory or very tight conditions, I want to say for a couple of months now. How much further can you see that tighten for this to actually be a successful way for the markets to function?
That's an excellent point. And perhaps the Fed doesn't even have to go as far as it's expected to do so at the 3.5% terminal rate and the big roll-offs of its balance sheet if the market does some of its work for it. You're right on that. Financial conditions are tightening, and that has a lag effect. So when you hear analysts come out and saying consumers doing fantastic, it's resilient, it's going to help us avoid recession, or it's going to make the recession very smooth or moderate in its magnitude, I would say wait a few months on that, because you have the combination of Here in the U.S., our net worth, the bulk of it is attached to our housing value and our 401ks, both of which one is getting hit more than the other. But the housing market doesn't look too strong either in the future. So I think that the months ahead, we're going to see both a rollover in the labor market, which is going to bring the consumer contract the consumer spending even more. And that's going to probably allow the Fed to not hike or roll off as aggressively as it has intended to do so.